You're about to listen to the Yet Another Value podcast with your host, me, Andrew Walker. Look, if you like this podcast, it would mean so much to me if you could rate, subscribe, review it wherever you're watching or listening to it. Ratings, subscriptions, reviews help me get more viewers, which helps me get better guests, which helps the podcast flywheel just keep spinning. But anyway, today I don't have to worry about guests today because my guest is me. It is time for my November monthly random rambling. I'm going to ramble quite a bit today. I have 4 topics that I want to talk about. The 4 topics are wins that lure you into security, things that you pass on that drop that you then go on to buy, and my history of that not working out well for me. Shorting the AI bubble, and I've got quotes around the AI bubble, and I'll say shorting is risky. See the full disclaimer at the end of the episode. But I've got thoughts on shorting the AI bubble and the risks, parallels. People draw parallels to the .com bubble, but I think there might be another parallel to keep in mind. No firm thoughts, but I just interesting, thought-provoking experience to think about. I'll obviously explain that during the ramble. And finally, some thoughts on trusting management NAV and numbers and how you can make that work for you, why it doesn't work, all sorts of stuff there. So I'm already starting to ramble. Let me go to our sponsors and then we'll dive into the monthly random ramblings. A word from our sponsors coming up. Today's podcast is sponsored by AlphaSense. Look, you know AlphaSense as a longtime sponsor of this podcast. I love all their tools, their burgeoning AI tools. I love their expert networks, and I increasingly love their webinars. They are sponsored this podcast. The next webinar they have coming up is PE distributions. Is the drought finally over? They're going to be talking about, go on Twitter, go look. Everyone's talking about, hey, the PE, the IRRs, are they real? Where's the cash? Where's all this sort of stuff? So they've got a great set of speakers who are coming on and talking about all those things. Hey, if they open up PE and alternatives to investors, what is that to retail investors? What does that look like? They've got a great set of speakers. It's Ted Siddides from Capital Allocators and Xavier Smith, the director of E&I Research AlphaSense. It's launching November 18th. There'll be a link to the sign up in the show notes and on the blog. You can sign up there. And thank you to AlphaSense for sponsoring this episode. All right. Hello, and welcome to the Yet Another Value podcast. I'm your host, Andrew Walker, here today for my monthly random ramblings. It is Sunday, November 9th, and I'm going to ramble about 4 things. I'll tell you what those 4 things are in a second. But first, quick disclaimer, remind everyone nothing on this podcast is investing advice. I don't think I'm talking about any specific stocks here, but if I do, I'm just rambling for 30 minutes or so. So please see a full disclaimer at the end of the podcast. And remember, not investing advice. Today, I want to talk about 4 different things. Normally it's 5, but it's 4 today. Maybe I'm less thoughtful this month. But the 4 things are wins that lure you into security, a false sense of security, and then kind of a related thought on things that you pass on that drop, and then maybe your bar is a little bit lowered. And again, I'm going to explain all these. I realize I'm just kind of rambling and saying random words. Then I want to talk about people shorting the AI bubble, and then I want to wrap this up with something on trusting management NAV, trusting management numbers. So let's hop into all that. First thing I want to talk about, wins that lure you into security. And I love to explain things with metaphors and stories. I'm a little bit of a storyteller, I like to think, probably not a very good one, but let me give you a story. I don't gamble much. That's the honest truth. I'll do, if I'm watching a basketball game, I'll slap $20 on a team or the over-under just because it's more fun. A basketball game lasts 2.5 hours. $20 is what you'd pay for a movie these days. And watching a game with $20 on it, it's better EV than going to the movies, right? So I'll do that. I don't really gamble a lot, but every year I do, or at least the past 3 years, I've gone to Planet Microcap in Vegas. It's been a ton of fun. I'd love to see you there if you're going, etc. But, when I go to Planet Microcap, it's a ton of fun. And I give myself a gambling budget, like $300 to go. So not crazy. That is money, but 3 days, $300, it's not much. If I lose it all in one drop, okay, I'm done gambling. If I can make a little bit and make it last, great, awesome. So I'm not going crazy. I like to think I'm an investor, but I like craps. That's my game of choice. I will play some blackjack, but it's generally craps or blackjack. And craps is a really funny game. For those of you who don't know, craps is the game where you roll the dice. And if you have never played craps and you hop onto a table, and the table, it's called getting hot, where the table you're just throwing point after points and the whole table's winning at the same time. The table's hot, the shooter's on a heater, whatever you want to call it. If you bring somebody new to the craps table and the table's hot, they will think that you've given them access to a free ATM machine, right? They'll know that that's not how it works because casinos aren't built on giving it. But I mean, you'll do it and you'll be like, I can't believe the house has an edge on this. This is insanity. And the house does have a very small edge in craps. But the thing with craps is it's extremely high variance, right? If the table's hot, you can make 10 times your money in a second. And if the table is cold, you can lose all your money in a second. So Why do I mention that? Oh, so I bring a friend this year. He's never played craps before. He comes to Planet Microcap. He comes with me. We go to a craps table. The table is hot, and we were laughing about it. He was like, "This is a free money hack. This is the infinite money hack. This is a free ATM, right?" So you're laughing. He made 5x his money in night one. I think night two he had a great night too, talking about how this is free money. But the casinos, again, there's no free money at the casinos. The odds catch up to him in night three. I mean, not literally lost his shirt, but all of the winnings were gone, right? And that's kind of the fun of it, right? As long as you don't have a gambling problem, that's kind of the fun. You go, you have a great time with your friends. We've got the stories of the big highs and the big lows. So why do I mention all this? Well, first I mention it because, he's my friend. I had two friends who were doing this. We'll see if they listen to the podcast, if they reach out and they're like, "Hey, you tell my stories." We'll see. But the main reason I mention it is I think about it when it comes to themes and strategies, right? If you invest in a theme or strategy and there are 5 winners in a row, is it evidence of skill? Or did you kind of go to the craps table and the craps table was hot and you rolled 5 times and now you're overconfident in yourself and you don't know how to edge it? And I'll give you an example with myself. I still look at a lot of legal special situations, and I used to do a lot more of them. And I would say the first kind of 7 years of me professionally investing, to the extent I am a professional, I had very few legal losers. I mean, it just felt like one after another winning winning on antitrust bets, winning on MAE bets, winning on every legal situation was a winner. And over the past 3 years, I feel like every legal situation I've looked at has been a loser. And that has me wondering, the first 7 years, was that a hot streak? Was that a hot streak? Was I more selective in my diligence? Was it just a hot streak? Did I just get lucky? What was it? If I was just lucky, did I ever have skill or edge there? Or again, was it luck? Is this an area I should be looking at? The last 3 years where they've all been losers, is it because did my diligence get work? Was it luck? So I was investing in an area where I had no skill. Was I riding a wave and, maybe again, my diligence dropped because I said, "Hey, I know legal situations. I can do this. I am good at these. I can assign odds better." I don't know, but it's something I'm really thinking about. And look, I say legal situations, and then you would say, "Hey, Andrew," I remember every Twitter podcast I did, and Twitter was obviously a big winner and one of the winners I refer to. Every Twitter podcast I did, I'd start and say, "Hey guys, I am not a lawyer. So who am I to say I have edge competing against lawyers, competing against people who are trained in this thing, just kind of jumping as a generalist? I don't know." And then, I would say, a lot of times I will talk to journalists about ideas and they'll hop into, and I'm the exact same way, right? Hop into ideas in sectors that they're not specialized in and think they can make money. And is that the height of generally I hope all the people who are smart, is that the height of ego that you can say, "Hey, I'm not specialized in this sector, but I can kind of parachute in, learn everything and make money investing in this sector"? The height of ego? Are they on a winning streak? Or is that crazy? I don't know, but it's something I've really been thinking about a lot. And, I guess this evolves from wins luring you into security to what I thought as I've continued to rambling. It kind of dives into, hey, where is your edge? Where can you get edge? Where can you express edge? But let me bring wins that lure you into security. Let me zoom out and go a little further. I mentioned legal situations as my personal example. Another one I've really been thinking about, and if you've listened to this podcast, if you've read any of my writings, anything, you'll know John Malone is someone I think about a lot, an unfortunate amount, I would say. And the past 10 years, in my opinion, I mean, look, the man's a billionaire. I'm about to say this. The past 10 years, in my opinion, have not been kind to John Malone. I'm sure, again, he's a multi-billionaire. I'm sure they've been kind enough to him. But his empire has really crumbled over the past 10 years. Go pull up the stock of any of the Liberty trackers for the most part. I mean, Formula One's been great. But aside from that, none of, Sirius hasn't worked. Charter was a big investment for him. That hasn't worked. Like, I think I do have a small investment in Charter that we can talk about, but it's not a big position anymore. But I was very wrong, and it didn't come into play here. Charter hasn't been great. Warner Brothers Discovery has been a disaster. All of these things, like QVC on the verge of bankruptcy, Sirius XM, great 20 years ago. Past 10 years have been a disaster. Like, everything's been a disaster. And it's got me wondering, the famous John Malone model was a levered buyback story, right? You got a growing business with basically a cable business, right? With subscription-based business. It grows, you add a couple more subs, you get a little bit of pricing power. So it grows every year. you keep leverage constant on it, 4 times EBITDA or whatever. EBITDA goes up every year. So because you're keeping that leverage constant, you generate cash flow, and you get an added boost of every year. If EBITDA grows by 10%, you can increase your debt by 10% because you keep your leverage constant. You can return increasing amounts of free cash flow to your shareholders. So that was the John Malone levered buyback model. And that's what made him rich, right? And I do wonder, John Malone practiced the levered buyback model from 1980 to 2010 is when it's just at its absolute best, right? And that is a period of declining interest rates, and it's the best period for media in history. So he's got that double tailwind. And I wonder if, all of us value investors, we get obsessed with the levered buyback stories. And I wonder if it's actually not as good a story. Point me to one that's worked over the past 10 years, few and far between. And I wonder if it was not, hey, this is a great model, even though mathematically, intuitively, it does make sense to me. So I don't know, but I wonder if it wasn't as great of a model for a world that, admittedly has thicker risks. I wonder if it was really benefiting from dual tailwinds of declining interest rates. That's the main one. Plus the media companies from 80 to 2010 are kind of in the best of all worlds for them. And they've just been devastated over the past 10 years as their moats have come down. But I wonder if he was more a product of the tailwinds he was riding than his kind of strategy actually being great. And now this is hard to say because I still got a lot of respect for John Malone. And one thing I didn't say was John Malone's not a genius because the man is off the chains bright. He's an electrical engineer, PhD, all this. Like he is absolutely bright. I think the levered buyback model makes a lot of sense in the electrical engineering, the mathematical, the Excel spreadsheet model. But it was a big winner from 80 to 2010. And I wonder if that is just the tailwinds. And, it has not worked over the past 10 years. Malone's empire has not crumbled because it's still together, but almost all the pieces have done disastrously. And they're all practicing this levered buyback model. And many of them, they practice levered buyback model for the past 10 years. And over the past year or two, they've had to really hit the brakes and in many cases reverse it, raise equity capital, reverse it. Like they're on the verge of bankruptcy. So I don't know, but that's one thing I've really been thinking about. Wins luring you into security, and that applies both to individual investors and kind of different themes they like to invest in, different strategies they like to invest in. And honestly, it applies to management teams, companies overall pursuing different strategies. Related thought I have. Let's move to the second thought. Things that you pass on that drop. So, every now and then, a few friends will pitch me an idea. An idea will get hot among kind of the value event investors I like to talk to, and they'll pitch me an idea. They'll be like, "Hey, this is a great growth company. This is awesome. This is the next big winner." Again, I respect my friends a lot. They're all smart, and 3 of them will come to me and say, "Hey, I'm long this company. Look at this diligence. Look at this. This is great. It's growing. It's cheap. All this sort of stuff. I love this. Blah 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 blah." And I'll research it. And for one reason or another, I'll pass. In one case, I'll give one anonymized example. A bunch of my friends are long a company, and they're long it because they say, hey, the EBITDA is it's really cheap on an EBITDA basis. EBITDA is growing, all this sort of stuff. And I look at it, and the EBITDA to me, the accounting was impenetrable to me. I thought the add backs were crazy. The cash flow and the EBITDA did not really match, et cetera, et cetera. So I saw, and I'm not accusing like anything untoward. I didn't think the economics of the business were as good as what they were pitching. Okay, so I pass on it. And then fast forward 6 months, my friends are pitching at 50. I identify, I pass for the accounting. Maybe there's another risk or two I identify. I pass. The stock announces a terrible quarter, and the stock goes from 50 to 30. And maybe they say, hey, our accounting, we had problems with it, whatever, right? There's a risk that I identified that played out. And actually, accounting might not have been a great example because I specifically am talking about times where you identify a risk and it plays out. You say, hey, that soda company you're talking about is great, but I'm really worried that Coca-Cola is going to enter that market. That dating app company you're talking about is great. I'm really worried that Facebook is going to enter that market. You identify that risk, you hold off, then that risk comes to pass and the stock gets hammered, right? Stock goes from 50 to 30. I have found that is a very difficult setup for me. I have multiple times it's gone from 50 to 30, and then I've bought the stock, and then the stock's gotten crushed. It's actually been perhaps my worst performing investment. If I go back, I like to go back through what were my worst investments, what were my best investments. Perhaps my worst performing bucket is stocks that I initially passed on. I had a bunch of notes. It dropped. The risks that came out to play, it dropped. I buy it. and it's a disaster. And again, to the winners luring you into security point, I have been wondering, is there something, look, this is a fault on me, right? Because obviously people can pass on things and buy them and have them be successful investments after they drop. I've been wondering if there's something mentally with me where, hey, do I think, oh, I correctly identified the risk that took it from 50 to 30? I know this company stone cold because I identified that one risk. Like, what is wrong with me? What is in that scenario, in that setup, what is causing me to perform so poorly, right? Because the answer cannot be, hey, every company that I pass on that has risks, I just pass on for the rest of time once the risks have come to play. That can't be the right answer, but maybe it should be, because I'm telling you, these are the worst investments I've ever had. So I've been thinking a lot about, for me mentally, what is happening there, how to readjust, how to reframe it. And I bring myself into it, but I'm pretty sure that I'm not the only one who can have this problem or the ones learning you security problem, because these do seem pretty applicable to most investors. So I've been thinking about that a lot. How do you reframe, if I'm constantly getting into these situations where I pass at 50, the risk hits, the stock drops at 30, I'm buying it and then it's dropping again. How do I reframe it? What am I doing wrong? What diligence am I skipping, or what step am I skipping? What is happening there where I think, because it's gone from 50 to 30, and I identified that risk, I am not doing enough diligence, or I'm thinking I understand what's going on there. So that's the second thing I want to talk about. Let's go to the last two, and these can be shorter. I always forget to keep track of time when I'm doing these, so I don't know if I've been rambling for 20 minutes or 20 hours. But shorting the AI bubble, and I'm putting AI bubble in quotes there. I think the past 3 months, there's been a heavy drumbeat of people claiming AI bubble. About a week ago, there was the now infamous Sam Altman basically hanging up on a podcast because someone asked, hey, you're a $10 billion company that's promising $1 trillion of CapEx over the next 10 years. How are you going to fund that? But for the past 3 months, 6 months, whatever it is, people have really been talking about shorting the AI bubble, right? And I think the most popular ones I would hear, and I think you'd have to be crazy to short either of these naked or anything, and shorting's extra risky, disclaimer, all that sort of stuff. But I'm just talking about the most popular ones I generally hear are Palantir and CoreWeave, but there are plenty of other. The reason I choose Palantir and CoreWeave is because they trade at nosebleed valuations, and both of them have, I would say, questionable economics, questionable TAM, questionable competitive moats. Doesn't mean that they're not great companies. I'm just saying, I think those questions could be raised, right? So especially value investors, I think, look at these and say, oh my God, the valuation is insane. Competition is looming. All the steps, CoreWeave, questionable economics, all this sort of stuff, and they short them. And I get it. And when these people short them, they say, hey, they're drawing the parallel, they're drawing the pattern recognition to, I am shorting these companies at, I'm shorting the top of the dot-com bubble. Was Cisco a great company? Yes. But if you shorted it in late 1999, early 2000, and you could hold on because I think it did run up a little bit, but the stock got crushed. The valuation was insane. And Palantir, CoreWeave, all these guys trade for even crazier valuations, I think, would be the argument. So I totally get that. But I do wonder, people also forget, in kind of 2010 to 2015, there was a steady drumbeat of hedge fund managers who, with really good track records, actually, who would make buzzes about shorting a lot of the tech companies. And the ones I'm particularly thinking about are Tesla, Netflix, Amazon, Salesforce, a bunch of other ones, though. And they were short these. And the thesis was, there were lots of theses, right? But the main thesis was accounting and valuation. I specifically remember Netflix as a kid, how they depreciated their movies and their owned IP. Got lots of questions from short sellers. Amazon never turned an economic profit, right? Salesforce, crazy valuation. So those were the shorts. And the shorts would say, hey, these are great. Maybe they'd say they were great companies. Maybe they wouldn't, but they would say the valuation is sane and this dot-com bubble. All of them got their faces ripped off, right? All of them got their faces ripped off. Go pull up the Netflix chart. Go pull up the Tesla chart. Go pull up the Amazon chart. Faces ripped off. So I do wonder, with Palantir and CoreWeave, yes, I get the questions on the long-term economics and everything. I get that. But people draw the parallels to, hey, I am shorting the dot-com bubble, and I hear it. But you could have made the exact same arguments for these great companies that became the Magnificent Seven, all this sort of stuff 10 years ago. And you were just dramatically wrong. right? Like you got your face ripped off, and many of them turned out to be the best businesses of all time. I'm not saying Palantir or CoreWeave get there, but I think people talk a lot about the AI bubble side. They talk about the valuation. They talk about the AI bubble side. People say, oh, I'm going to short this. Oh, crazy inflated. I get that. And then I hear people on the short side, or I hear people who kind of fall into the camp that I actually admittedly am, where they're just like too hard, don't know where it's going, can't short meme stops, all this sort of stuff. I don't want to touch it, right? So I hear those two camps, but I very rarely hear the third camp. And maybe it's because I'm not talking to enough retail bulls, I don't know. But I very rarely hear the third camp of, hey, you would have said the same thing about Amazon, Netflix, Tesla, all these guys 10 to 15 years ago. You would have been decidedly wrong. What if we're not on the dot-com bubble 2.0 path with these guys? What if we are on, hey, these are actually the companies of the future? Because if that's the case, there's still probably a lot more room to run. Now, they trade at such big valuations. They trade at such big market cap, maybe not, but I think it's an interesting other side of the coin and just something to consider, think about. I wanted to put that out. Last thing I wanted to talk about. Trusting management. Now, I've talked about trusting management on this podcast and on the blog a few times, and I've generally meant that I've gotten friendly with a management team, and they've, to be honest, pulled my pants down, right? I thought, hey, these guys are good guys. They know what I want. They know what I expect. I respect them. I think they're thinking about the world right. They say, hey, Andrew, we understand we're undervalued. We would never issue equity in a deal. We get it. Like, we're working towards shareholder returns, all this sort of stuff. We see the same value in our shares that you do. We're working towards shareholder returns. We get it. And then 6 months later, they say, hey, look, we had the opportunity to do the deal of the century. How could you have us turn down the deal of the century that had us issue, 50% of our equity at these cheap prices? And by the way, management didn't do it because we'd be running a bigger empire and we'll get paid a lot, but that type of stuff. So that's the trusting of management. Hey, I believe they're going to do the right thing for shareholders, despite maybe their incentives not being aligned or everything. I think they get it because I'm friends with them and I've talked to them. I've shook their hand. They've got a solid handshake. I always think about that. What I'm talking about here is management numbers and NAV. And the two in particular I would talk about is a lot of companies will do investor days and they will publish 3-year targets. And famously, I don't have statistics or studies on this, but I'm pretty sure most companies miss their 3 years targets when they put them out, and pretty dramatically so. The SPAC bubble would be the fantastic one, right? The SPACs in 2021. How many SPACs put out revenue projections that said they'd be earning $5 billion? This is late 2025 by this year, and many of them still haven't generated any revenue, but even more than that, there are big companies that put out big long-term targets. A famous one might be IBM with Buffett in the early 2010s. They had their famous, hey, here's our long-term EPS target, and they missed it dramatically, right? But management love to put out numbers at investor days. And the other thing I find a lot of management teams like to do is they like to put out NAV slides, not net asset value slides, right? They like to put them out that says, hey, here's our here's the different pieces of our company. Here's how much they're worth. Here's what we think our stock is worth. And I will call myself out on this, but I think plenty of investors will agree with me. It's very easy for me especially the NAV slide. Management lays out the NAV and they say, hey, look, we own 5% of this company that's valued at $1 billion. That's $50 million of value there. 10% of this company, that's $100 million. They lay that all out, and then it comes out to a nice number that says, hey, we're worth $1 billion. We have $100 million shares outstanding. Our shares are worth $10 per share on an NAV basis. We trade for $6. We trade at a 40% discount. And look, I will obviously go and check the assumptions under every piece of that NAV. But I will tell you, my history has been, even if I check the assumptions and I think the assumptions are good, my history investing in kind of management NAV stories has been not great, right? It's not great. And even when the assumptions are fine, and I think there's a lot of reasons for that, but it's a lot of reasons. In particular, management NAVs never give discounts for corporate overhead, which I always do, but the corporate overhead a lot of times is running pretty big. And once you kind of capitalize that, it takes a big chunk of that NAV discount away. But even adjusting for that, I just don't think I've had a lot of success when a management publishes an NAV number that says, obviously it says the NAV is higher than the stock price. I buy the stock. I don't think I've ever had much success in that scenario. And I wonder why that is. It could be possible that the reason is I talk all the time, hey, you need an edge that is not in the numbers, right? 100 years ago, if you're buying stock in the 50s and the 60s, and you were calculating, hey, book value is 10, the stock trades at 5, this is a buy, that could work. Today, that's done by quantitative computers. And if you're trying to compete on that, you're going to get outcompeted 100 times out of 100, in my opinion. Maybe it's the same thing with management NAV, right? Like if management's presenting the NAV, the market knows it, and it's trading at a discount for a reason, doesn't mean it can't work, right? Because if you say, hey, I think management is much more incentivized to unlock this NAV than the market believes, that's a thesis maybe. But just saying, hey, management's got NAV at 10, the stock's at 5, that's probably not a thesis. I will tell you it has not worked for me. And it's something I've been thinking about, hey, A, how do I make myself more skeptical of some of these management teams in NAV? But B, why hasn't that worked? And how can you kind of tweak that? Because I am a value investor at heart. I do want to buy stuff for less than they're worth. How do you tweak that? So, hey, I can, buy stuff for less than they're worth. I can find these NAV discounts. I can have management kind of guide the light, but I'm not constantly buying things at a discount to what management says it is, and then never realizing value. And, I'll give one very fast example. Liberty Sirius XM. I like this example because anyone could do the math. The management, Greg Maffei, who was the Liberty CEO at the time, would do the math all the time, right? Sirius XM traded for $4 per share. That implied that Liberty Sirius's NAV, which was basically all Sirius XM stock, was, if I remember correctly, $40 per share, and Liberty Sirius traded for $25 per share, right? And Greg Maffei would say all the time, hey, this is the discount. We know it's there. We're going to attack it. We're going to buy back stock, all this type of stuff. And the reason I like using this is because it's a great example, and also it plays the Malone stuff I talked about earlier. He'd say that all the time. But I think the interesting things that happened there was, A, he would always say, we're going to buy back shares, but at multiple points when things got stressful, they would stop, or they infamously, I don't know, did a rights offering to save the rest of Malone's empire in kind of the COVID times. But B, you could do that math, but I think a lot of people would say, hey, SiriusXM, kind of for a business that is challenged by Apple Music, Google Play, all this sort of stuff, trades for a pretty high multiple. Maybe the issue isn't that Liberty Sirius trades for a discount. Maybe the issue is SiriusXM stock is inflated because Liberty Sirius controls so much in its stubco. And that actually is kind of what happened when the two collapsed. It wasn't Liberty SiriusXM stock going up to meet the SiriusXM stock price. It was SiriusXM stock price that came down to meet the Liberty Sirius price as kind of the float normalized. Now, that is a silly example, but I've got plenty more of companies where they publish NAV numbers, and the Liberty Sirius was a simple NAV, but I've got plenty more where companies publish an NAV number and they say, hey, we've got a chemical code that's worth 10x. We've got a paper code that's worth 5x if you're just using pure multiples. You put those together and our stock price is worth 20. We're trading at 8, huge buy. And it never works. So did it work for them? No, but maybe it'll work for us. I don't know. But anyway, I'm going to wrap it up there. Again, I don't know how long I've been rambling. One of the reasons I do these ramblings is people like to, I think some people, maybe I'm inflating myself. I think some people like them, but I love having discussions on these points. So if you listen to this ramble, and I don't expect every point I made to hit with you, but if you've got thoughts on things that you pass on that drop and you say, hey, Andrew, maybe this mental model would work for you, or I've been thinking something similar, reach out. I'd love to chat. I'd love to chat anytime. You can always reach out. Please feel free. The only caveat to that is if you listen to the October ramblings, I'm expecting my second child. I thought that was going to be my last one. My wife has decided, her body's decided to keep the baby in for the full term. So that second child is coming real fast. You will not be hearing from me for a couple weeks after the child comes up. Maybe I'll be doing a December rambling, but you reach out around Thanksgiving time. There'll be a 2-day-old baby. I won't be responding then. But my wife also, she's doing great. She's a trooper. She's got more energy than me. She looks incredible. So really excited for that. But I'm rambling. That's the point of rambling. I'm rambling. Thank you for listening. Again, reach out. Would love to swap thoughts if you ever want to. See the disclaimer at the end, all that sort of stuff. But I'm looking forward to talking to you on the other side of the baby. A quick disclaimer. Nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.